So, good morning, everybody. Today, we're going to touch on being intentionally unintentional with opening positions. So, in my previous video, I highlighted what actually moves the markets, what drives the markets, why the Federal Reserve, why the economic calendar is important and pivotal, why is commercial banks important, why are interest rates important, why are these events important in terms of trading the financial markets. So, these videos are created um, for those people who are looking to go into trading and investing on the financial markets, particularly for CFD, contract for difference, which means that you are trading in your own capacity, in your own time. However, you are assuming all the risk, right? So these videos are to help mitigate that risk, to help you be more intentional with the positions that you open so that you are able to generate potential profits and mitigate the risk as well. Okay. So in my previous video, we discussed the importance of the economic calendar, the importance of the Reserve Bank, the importance of the commercial banks, fiat currency. What does that mean, and why it is pivotal for you to understand in terms of trading forex. All right, government data, the unemployment rate, and the effects it has on trading forex. Because as you trade from an informed perspective and you are intentional with the positions that you open, you are therefore most likely to mitigate your risk and generate potential profits. Okay. So today we will discuss the events of the economic calendar. Not all the events on the economic calendar has the ability to move markets in a major way. So for example, we have NFP, right, which is non-farm payroll, which is also provided on the economic calendar. Normally it is on the first Friday of every month, right? Now this has the ability, NFP has the ability to move the market in a very great way, okay? However, the effects are very quick, meaning that you've got to enter the market, you've got to be online, you've got to you've got to make sure that you open the position and actually close it, because by the time the data is released, it's already too late. Okay. So when we look at the economic calendar, we view the events, the time. Okay, so the time is very important because NFP normally, if it's South African time, it's normally around 3:30. Depending if there's daylight savings, the event may be a little bit later. So normally you got to look out between 3, 3:30, etc. Right? So it is very important for you to view the events on the economic calendar. So the economic calendar, as I've mentioned, you go to investing.com, you go to the economic calendar, you see the time that the report is going to be released. You're going to see the flag, which represents the country, and then you're going to view the currency, okay? And then you are going to see the event, right? So this is going to determine how you need to trade your forex pair for that particular day, okay? So those respective reports, they released because if you are trading in your own capacity, CFD is contract for difference, right? And your margin, meaning your account balance, is minuscule, okay? So if you open a position too quickly, let's say for example it's a major event like NFP, all right? And prior to that result being released, okay? Now, this is not something that we actually like, or these events, like let's say for example a country is bombed, right? Hypothetically speaking. Now you opened your position prematurely on that particular forex pair for the event that is going to transpire later on in the day. In the USA, it might be a little bit earlier. And it just so happened that maybe 5 hours prior to that, a bomb went off in that particular country. So it has the ability to cause a volatility, right? Because why? Remember, countries and currencies, they are together, they are synonymous, they go together, right? It's the reason why I'm saying synonymous, it doesn't have the same meaning, but I'm saying in terms of trading, it means that they go together, right? Because you cannot trade a forex pair without a associating it with a country, because every country has different data that is going to be released. The data in America that is being released, the non-farm payroll data, is not going to affect me all the way in South Africa. It can affect my position that I opened. However, it's not going to affect the unemployment rate here in South Africa, if you know what I mean. So that is why I say that it's synonymous. It's like sort of like it goes together, okay? Like peanut butter and jelly. So in the event of that occurring, it could be that you may liquidate your account, right? Based off your position being in the wrong direction, although maybe according to the report, it might have been in your favor, but because of that event that actually transpired prior to the NFP results being released, you might have not maybe had enough funds, and you maybe holding that position, and because of that event or that that bomb that went off or whatever the case may be, it could affect you, and you could actually liquidate your account before even opening that, before even generating a potential profit or potential loss on the NFP data that is going to be released. All right. So the US dollar is the number one traded currency around the world. All right. Why is the US dollar so important in terms of the world and how it actually affects the whole world, all right? Because whatever happens in America, it does affect everybody around the world as well. Because why? All the countries around the world, they have US dollar reserves. So even when you go on the economic calendar as well, you're going to see the countries updating the US dollar reserves that they actually have, all right? Even in South Africa as well, we also have US dollar reserves as well, okay? And also on the trade account, the trade balance, it's traded in US dollars, all right? So even though our currency in South Africa, we use is the South African rand, when they are trading in terms of imports and exports, that is what I'm meaning now, it's traded with the US dollar, okay? Now, that is why it is very important in terms of the events that happen in the US, because it does affect, it has a direct correlation as well with all the countries around the world, right? So on the economic calendar, together with the trade balance data, the US dollar is a major currency, right, when trading forex, and it has a direct correlation as well with gold, meaning if gold is up, the US dollar is going to be down, all right, and vice versa. So meaning that if the US dollar is trading weak, then gold is going to be strong. So which means that you could open two positions, trading the commodity of gold and trading the forex pair, okay? Meaning that you can capitalize off both of those instruments that you have opened. Bearing in mind that the liquidity, the margin that is required for trading gold and trading forex is different, as I've mentioned, because forex trades with pips, right, which are normally the last decimal points, and that is going to establish how you are able to generate your potential profit, okay? So I'm just going to give you an example as to what I'm actually meaning. So when you are looking to trade a forex pair, okay, so to prevent maybe that from actually occurring, what I've mentioned, if the war is declared or some country was bombed, and because those are things that just occur. Nobody, only if those respective countries, obviously, they go and prepare and plan for it. But us, in terms of the average person, we don't know that that is actually going to occur, all right? So when you are looking to open positions on forex pairs, okay, there are forex pairs that are a bit steady in terms of the movement, that won't provide you with which won't affect your trade account in a massive way. So the volatility, it is there, however, it is not that volatile in terms of the movement, okay? So it would be the Great British Pound versus the US dollar, and the symbols are GBP versus USD. It's the Euro USD, which is EUR versus USD. And something that is a little bit more volatile is the US dollar versus the Japanese yen, all right? Now, the reason why I'm giving these respective instruments or respective currency pairs is because these are the ones that you could um, tend to trade if you are someone who is new, who is a novice, right? Instead of trading a more volatile forex pair, okay? Because the higher the volatility, the higher your potential returns, meaning that you are able to generate your potential profit or loss, okay? Based off that currency pair, based off the margin that you have used, which is basically your trade balance in your account, which is your funds in your account. Your margin is basically your money in your account, all right? And what you have in order for you to open those positions, okay? So normally USD JPY is something that will be traded on the day that NFP is released. However, the movement is it is quite a bit more volatile in terms of GBP USD. So if you're someone who is new and you're still learning how to trade forex, um, I won't say that you need to trade that. However, maybe if you want to open a small volume in lot, then you can analyze and see how the market actually moves in terms of the movement so that you are able to make a decision based off how you would like to trade in the future in terms of forex pair, okay? So one can establish the results of NFP, which is non-farm payroll, based off the instruments, right? Based off the instruments and fundamental data. So I have found out a way to basically know the results of NFP without the government data being released, and this is um, taken some time because I've just figured it out using fundamental data, right? And also you're looking at a bit of the instruments as well, and in terms of the movement and the volatility of the pairs, right? But mostly it's fundamental data. Now I can't give you all my secrets because these have been tested by me, by myself, and let's just put it at that. So this is something that I have, I go to using a lot of fundamental data, and I've put two and two together, and I've found out, okay, this could be the potential, data. This could be the feed. Let's just say the outcome. So this could be the outcome of the NFP data without me having that government data, all right? And this is what I assume the outcome to be. Now, not everything is 100%, and that is something that also you got to keep in mind, okay? So you can trade the news, which is fundamental data. This is all your factual data, your information that is being released, and then you have your technical data as well, okay? So the reason why I started off on talking about the Reserve Bank, commercial banks, and the fiat currency, because that is fundamental data. That is information that you need to know in order for you to be informed in terms of trading from an informed perspective. Because if you just go and open a position, let's say, for example, on USD JPY, and you don't know what is transpiring in that particular country, you can liquidate your account, or it won't be that effective. So you would be wondering, okay, maybe you just wake up and you say, okay, today I'm going to trade USD JPY. You're not looking at the events that are going to happen or what event it is, because as I've mentioned, it also depends on the event. Some of them don't have the ability to move the market in a substantial way. So maybe you're looking to make $2,000 in half an hour or a couple of minutes, all right? But what actually happens is now you didn't achieve that. So that can also play a role in the psychology of trading, because you will end up getting frustrated, and then what happens is you can open a position in the wrong price, the wrong direction, and then you would end up blowing your account and go the opposite direction. So the basis, every strong and sturdy building always has a firm foundation, and the firm foundation is for you to understand what moves the market so that you're able to trade from an informed perspective. Are you going to get everything 100% correct? No, of course not, because even the most experienced traders don't know which way the market is going to go 100% if they're saying that they are lying, right? So, who controls the forex market? Who is controlling the forex market? This is your Federal Reserve, because as I've mentioned, it's got to do with the repo rate, which is the repurchase rate that is set, and then we have the commercial banks as well. All right, and they are the ones who control the forex market. Okay, because these now are currencies, right? And banks deal with currencies, and the Reserve Bank deals with currencies. They regulate the flow of the cash within the economy. So Forex is also open 24/7, so you can scalp according to events, right? So scalping is basically trading for 15 minutes, opening a large position or opening a short position, closing it, opening positions again. That is what scalping is. So you can also hold depending on the currency pairs that you have chosen. So GBP USD is something that you're able to hold. Euro USD is also something that you're able to hold. Bearing in mind as well, go back to the economic calendar, see the events that are actually happening, because at the end of the day, maybe you were thinking, oh, I'm going to hold this position. And what happens is now those events, the data has been released, and now you've seen that the market has moved against you, right? So we also have to discuss what are trading CFDs, okay? So trading CFDs, or trading, is speculation of the movement of the price action of the underlying asset, and you derive your profit or loss based off the fundamental and technical analysis, all right? So to be effective, you have to analyze the data being released. For example, NFP, non-farm payroll, or CPI data, which is consumer price index, and you view the country, for example, the US dollar. Now you can, and the currency pair that you want to trade, you can also take a look at the other currency, the other country, right? Sorry, and what data is being released. So you check the technical indicators as well, 15 minutes, 1 hour, and you can also have a look at the movement as well in terms of the volatility, because that is also going to determine if you are going to open your position. Because if it's not too volatile, it could depend on what it is that you want to achieve. Remember, people have different ways, they have different needs and wants in terms of what it is that they want to achieve. And most of the time when we are trading, there is a goal in mind that you want to achieve. So one of the things that I would ask my clients is, what is it that you want to achieve? How much do you want to make? How much time do you have to spend trading? I would also just gauge as well, if the person is available, their mental capacity as well. Because if someone is a little bit more, because you're going to find out there's three types of investors. There are conservative investors, there's moderate investors, and there's aggressive investors. So according to the client's profile, you've got to decide, or the person's profile, you've got to take it from there, according, and also bearing in mind what it is that they want to achieve in terms of their financial goals, and also what type of investor they are. Because if you put an aggressive investor on something like stocks and shares, they might become bored and get agitated, and they don't want to reach the same result. So you've got to find out, right? You've got to ask the right questions in terms of what it is that you want to achieve. Everybody is different. Some people are more conservative investors. They tend to gravitate towards stocks and shares. And then you're going to see a moderate investor who would have a sort of a medium portfolio, which would contain stocks and shares, maybe indexes, forex. And then you have an aggressive investor who would trade commodities, who would trade forex, who would trade indexes. Okay, something that is a little bit more volatile to give them that sort of adrenaline rush that they actually want and require. Okay, so you need to also have a look at the right entry point as well, which is also very important. Because when you are trading, and now we were talking about technical indicators, so the only way you're going to be able to establish the right entry point is if you go on the, if you're on the trade account, you're going to see the price action. You're going to enter at the right entry point. So you've got to view and see where the candlestick is ending. So you've got to see where the right entry point is to enter the market and where it is you want to exit, because that is also going to determine your potential profit or loss. And remember, you need to be intentional with what you are doing in terms of trading. So especially when you're trading forex, the movement is quite a bit, all right, because it is traded 24/7. There are always constant updates. It's constantly moving, because countries around the world, when one country is waking up, another country is going to sleep. So the forex market is always open. Okay. So you also need to view your margin, which is your trade balance, your trade funds, the balance that you have in your account, and you select the volume in lots, which is your investment portion or your investment components. Okay. So 0.15 commodity, depending on the price action, is more or less the same investments as trading 0.50 volume in lot on a forex pair, right? Now, I stand to be corrected. This also depends on the forex pair that you choose to trade, right? Also the margin required, because different forex pairs, the margin, you can find that some of it for one volume in lot, it could be maybe $1,000 or $1,200, and you'll find that maybe there's a different, it would be a different amount, maybe $894. It would depend, okay? And then you have commodities as well, like for example gold, because gold, you are trading on the whole value. So if it is $4,000, you are trading on the whole value of $4,000, whereas when you are trading forex pairs, you are trading on the last decimal point. So in terms of math, it's going to be more of a, you're going to put in, especially when it comes to your trade account, you're going to need to open a smaller volume in lot in terms of commodity, if that is what you want to trade, for example. And then if you want to trade forex, you would open higher volume in lot, all right? Both meaning that you could actually get the same results. However, the investment component would be different, okay? Because of the price action and the movement as well, okay? So the margin for forex is a little bit lower, meaning that in order for you to see potential profits or more or less potential profits as the same as maybe a commodity like gold, oil, or cocoa, you would need to open a higher volume, right, of lot. A higher volume of lot just simply means that your investment portion that you are using. Okay, so when you are trading, it depends on the trading platform. It's going to ask you what is your volume in lot. So you're going to put in there maybe 0.10, 0.15, 0.50, depending on what it is that you have in your trade account. You also got to take into consideration that you cannot use all your funds, because you also need funds to sustain the trade that you have in case an event had to transpire and the market could move against you at that particular time, and maybe you were busy, or you just maybe stepped away. However, there are measures in place, which is a take profit and a stop loss, which will automatically open, which will automatically close your trades, okay, to prevent you from liquidating your account. All right. Now, also noting that CFD offers you leverage. So leverage is like a buying power, right, which assists you in helping you to achieve your goal in a shorter space, using less of your initial capital and you not assuming all the risk, right? So leverage is also very good in terms of when you are trading CFDs and a broker and trading in your own capacity, because why? It gives you the ability to trade in the capacity of someone who has got an asset manager. However, there are advantages and disadvantages. So the advantages of trading yourself, you can choose what and when and how you want to trade, and what events you want to trade, what time, how much you would like to trade, how much money you would like to invest. You are able to choose how much profit you want to make, if that profit is going to be enough for you or not, right? And then the disadvantage is there's no asset manager, so meaning that you are going to assume all the risk yourself, okay? meaning you have to make time, you've got to understand the data, you've got to assume the risk, also bearing in mind that no one can predict the market 100%. However, there are measures in place which can assist in terms of mitigating your risk, right? So if you're looking to trade CFDs or trade in your own capacity, this is just anecdotal information to give you a background as to how you can be effective in terms of being intentionally unintentional in terms of trading, all right? So that you are able to trade from an informed perspective and you are able to generate your potential profits, all right? Bearing in mind that you do or you will lose money as well, but if you follow the right events, if you do your due diligence, right? You are able to mitigate that risk. Okay. So you've got to understand the fundamental data and also look at the technical side of it as well, which we will go into as well in time. So thank you for watching. I hope you find this informative. Just let me know if there's something that you want me to go deeper on, and I will touch on it a little bit more in depth.